Oh, there we go. Can you go? Oh, there we go. Please, I might click. Yes, please. Have you got the billion? Yes.
So,
yeah.
I was finding it so much fun to a live event. So it was a bit of a shake for my name's Andrew Brook. I'm very pleased to welcome you to this session. If you have time afterwards, perhaps we just please do so. It is quite difficult to recognise people on Zoom or Teams. So it's with great pleasure that I introduce the Simmons team. And specifically, I'm going to introduce Elizabeth Williams, who is coordinating the presentation today. Elizabeth is a partner in the disputes area of Simmons and Simmons. Simmons are one of our very trusted partners. Very much looking forward to a very forward-looking presentation on future regulation of crypto assets. Thank you, Elizabeth.
Well, thanks so much, Andrew, and thank you everyone for being here in person this morning. We're delighted to welcome you face to face, which is certainly one of the first seminars that we hosted for the AFB post-pandemic. So delighted to have you here. I'll keep my bit very short before I hand over to Rosalie and Doug and Davina. This morning's session is meant to be quite informative, particularly on what is happening at the moment from a regulatory perspective, what the future holds, and we've assumed that everybody who's here is in a position where they're being asked questions by their business about what risks crypto poses, and indeed at the very early stages of trying to understand how crypto may affect their business, not just at the moment, but going forward, so that you can advise again your internal stakeholders on those risks. So just before I get started with some introductions, just a few housekeeping points. Thanks so much to all of you who have filled in our polling questions. This is really designed to help us guide some of the discussion this morning in the most relevant way for you. Hopefully they weren't too difficult to answer, but it's really just based on how is it affecting your business and what are you really worried about. In addition to that, we will be recording the main part of today's session, the substantive information delivery section, but we will not be recording the Q&A. And that is mainly for the purposes of being able to ensure that we try and have as much of a dynamic discussion as possible. Please feel free to ask any questions, no matter how simple they may appear. Certainly a lot of the questions we get at the moment that are prefaced with "this may be a silly question" turns out to be something that we haven't seen yet. So please do ask away. And if you prefer to do so through the medium of your Q&A function on our app that you should be able to access through the QR code, then please do. That would be great. I think that the only other point is the recording is only going to be made available to AFB members, so it will not be distributed more widely. So to the team, I'm delighted to introduce Rosalie Pretorius, who is a partner in our financial services regulatory team. Rosalie has advised a wide variety of banks, asset managers, etc. over many years, and at the moment is very focused on crypto regulation. So she is going to be our real bastion of knowledge here this morning. I'm also delighted to introduce Doug Robinson, who's a managing associate in the litigation team here at Simmons, who again is also particularly focused on crypto, and indeed at the moment is seconded to one of the major crypto exchanges. So I think should have some very interesting insights there, which will be hopefully useful to you all. And also I'd like to introduce Davina Shah, who's a supervising associate in our disputes team as well, who is particularly interested in fintech and crypto. So without further ado, let me just quickly run through. We're not going to go into great detail, but as you'll see, we've got a quick pit stop tour, what's happening in the crypto market, what is crypto, regulators' concerns, future regulatory developments, why might banks be worried about crypto, which I think is going to be one of the most interesting areas of this morning's talk. And indeed, we're going to look at some of the developing case story. And you'll be pleased to hear the last section on what our products are, we will keep to about 25 seconds. So don't worry that we're not going to be doing hard sell. So very briefly, what's happening in the crypto market? Now, most of you will already be very familiar with this sort of picture, but just seen, there are over 10,000 cryptocurrencies in circulation at the moment, and they have a market cap of $88 882 billion US dollars. Now, of that, 85% is made up of the top 20 cryptocurrencies. On the crypto exchange side, there are 298 cryptocurrency spot exchanges, trading volumes of 1.97 trillion US dollars in May 2022. There are 43 cryptocurrency derivatives exchanges, trading volumes of 3.19 trillion US dollars in May 2022. So you can see an enormous amount of activity on the exchange side. Now, investor composition, I think, will be particularly interesting. It is now very clearly moving away, not just from retail, but now to institutional investors. So over 80 million people hold cryptocurrency wallets worldwide, and that is set to increase despite the recent volatility. And finally, just briefly on crypto custody, 13 crypto exchanges custody 7% of the crypto economy, and Coinbase dominates with over 56 billion assets under management.
One thing I just wanted to add to this is that number of over 10,000 coins sounds really impressive, but apparently more than 2,000 of those are so-called dead coins. So dead coins are effectively ones which have been abandoned, don't have a website, the nodes are down, have wallet issues and so on. So there are certainly issues within what we've described, and we'll come on to that in a bit more detail.
Indeed. So that's just to really give you an impression of how significant this market is at the moment. And without further ado, and I'm not even going to focus on cybercrime, as I think that's something that all of you are fully aware of in this area, but let's move on to Doug, who's going to give us a little bit of a quick run through of the crypto winter that we may be currently in.
Yes, so this session is very well timed, coinciding as it does with some really quite dramatic developments in the market. And I think those developments will really illustrate some of the points we'll discuss today, some of the issues and the things that regulation will need to address in future to give a summary of some of those developments. The so-called crypto winter that you'll have read about has seen very significant losses in market values. So Bitcoin, Ether, Ripple, some of the major tokens have lost around 2/3 in some cases of their value. So a very material fall in value. And that's having an onward impact on other parts of the market. So you'll have probably read about Luna and UST. UST was or is a stable coin. And as the name suggests, it's intended to be a safe haven in the very volatile world of cryptocurrencies. However, it's not the case that all stable coins are backed by the thing they are designed to be pegged to or to track. In the case of UST, it actually relied on an algorithm to maintain its peg to the US dollar, and that's operating in conjunction with the Luna token. And in very high level terms, what happened is there are arbitrage opportunities created by the new issuance of Luna tokens, depending upon whether UST was above or below its peg. Now, what happened in practice when the market started to fall is there was a great deal of downward pressure on UST and Luna, and that caused the algorithm to effectively malfunction, or certainly malfunction in terms of the economic effect. It actually created something of a death spiral where excessive Luna was issued and it crashed the value of both tokens. Today they're effectively worthless. So that's been a very big development, and it's had an impact on other players in the market. So you'll probably have heard about 3 Arrows Capital. That's a crypto hedge fund which entered liquidation in the BVI last week. It's been reported that 3 Arrows was a big holder of Luna, so you can see the connection there. And it'll be very interesting to see what happens in terms of the liquidation of 3 Arrows and what comes out of it, because it's understood to have been a big borrower of crypto assets from lenders in the market. It also holds, no doubt, extensive crypto assets itself, which will probably be subject to claims and litigation. And in terms of the borrowing that 3 Arrows undertook, there's again a connection with some other events in the market. So Celsius is one of a number of crypto lending platforms, which is now either ceased or limited withdrawals by its customers. Many of those platforms operate a bit like a traditional bank, in that holders of assets can deposit them to an interest rate, and the platform will lend them out to people like 3 Arrows Capital, who will then use them possibly to speculate on the market, depending upon their business model. But what has happened in practice is that many of the borrowers have become distressed. They can't repay the loans, meaning there are problems with the platforms, they lack liquidity, and you've got what is a bit like a run on the bank, just in the crypto world. So it'll be very interesting to see how that plays out. There'll no doubt be disputes, I'm sure, which will follow, and regulatory action. And finally, all of this is also having an impact on some of the exchanges and brokers. So there have been reports of exchanges limiting withdrawals by customers, and it may be that one of them suffers a similar fate in terms of perhaps entering insolvency, maybe one of the smaller exchanges. So it's all very fast moving and dramatic, and I'm sure lots will follow in terms of legal developments. Rosie, anything you'd add?
I just want to add, we've obviously put the price there, and the price is potentially important in terms of all these legal developments, because it's been reported, and I can't vouch for it, but people are saying that the $20,000 is about the threshold value that you need to ascribe to Bitcoin for the validators to effectively validate the transfers of Bitcoins. So if that is correct, then at this price, they're going to want to resist doing that. And if that's right, then you're going to have more knock-on effects of the type that you've just discussed. So it's going to be very interesting to see what happens to the price in the next couple of days and months ahead. So what we did is we asked you all for your relationship with crypto, and I can reveal that 14 of you answered our questions. Thank you very much. Obviously, don't know who they are. So we first asked whether you have any crypto assets on your balance sheet, and 9 people said no. Nobody said yes to that. Nobody said yes to that, which is completely not a surprise. But 5 people did say no, but soon might have actual crypto on your balance sheet. And the other 9 said no, not in the near future. And then we also asked, because this is something that we see banks asking quite a bit, which is, do you offer clients a route to market? And 2 banks here said yes, through derivatives and structured products, which is very interesting. 6 said no, but you'll soon do so. And another 6 said no, not in the near future. And what's really interesting about the results is that they were exactly like I expected them to be, because they are consistent, if you look at the next slide, with a May 2022 report from the Bank of International Settlements on the institutional adoption of cryptocurrencies. And you'll see there that the major banks have very modest exposures to crypto, with just 2 basis points, 2%. 2 basis points, so 0.02% of risk-weighted assets, so very, very low. Activity is concentrated in the major crypto exchanges like Coinbase, who has 1/3 of the Bitcoin holdings. But there are exposures responding to client interest, because when you're in when we have been in a low interest environment, obviously things are now changing, then something that offers greater returns becomes very interesting. Crypto funds have become a gateway to crypto exposures, and bank funding in relation to stablecoin issuers have actually increased. So banks have provided products like commercial paper as a key part of the stablecoin asset backing. And that, as we'll see later, is a bit of a concern, because it means that there are now these connections between traditional finance and the crypto universe. The other thing that a number of major banks have actually done is they've invested in companies that are developing crypto applications, or applications using distributed ledger technology. So, for example, a number of the major banks are invested in a company called R3. R3 is based in Singapore, and they support a number of things, for example, Corda and various other applications, which look to using the technology in traditional finance in different ways. To illustrate, here is also from the same report, and you'll see that they surveyed Group 1 banks, and they did 2 surveys, which are the 2 first columns in each of these graphs. And the first one is the 112 Group 1 banks, and they have Tier 1 capital of more than 3 billion. And then the second part of the graph is Group 2 banks, and they were asked to respond to a data collection exercise, and you can see the result there with a very, very low percentage of risk-weighted assets. So only 7, and this was then, so it's a few months ago, so it's quite interesting to hear what you've said, but only 7 of the 178 banks participating in the BCBS data collection then had any cryptocurrency exposure, direct holdings. So clearly that is on the increase, and that's interesting to see. Okay, so here are a couple of examples of structured products that we've seen. So just to mention that we have a structured derivatives team or structured products team here, and they've actually structured a number of these products. And what the findings of the Basel Committee was is that people are actually using these sorts of products rather than opting to hold cryptocurrencies directly. And the reason for this is, one, operational complexity and safety. People like using intermediaries that they're familiar with. Another one is the fact that, and you'll see when I get to the prudential discussion, that Bitcoin in particular, Bitcoin and other crypto assets, are categorized as intangible assets by various accounting rules, similar to intellectual property. And that then makes it very balance sheet inefficient to actually hold them, because you can't effectively deal with them in the same way as you would in relation to funds that invest in cryptocurrency. So it's more efficient to invest in the funds. And then finally, so all these factors have come together to effectively make crypto funds and crypto products a gateway for banks to offer these exposure to these products to their clients. So we then come on to what is crypto. Now here we're not going to give you, you'll be very happy to hear that we're not going to give you the talk about how the technology works and so on. So I believe some of you have actually attended that, so keep that in your head. But what we're going to look at is just very briefly the legal classification, both in terms of regulation, so statute, as well as case law. So here are some definitions, one from the FATF and the other one from MiCA. And you can see that we're talking about digital representations of value is a key factor in the definition. The other one is transferability. And when you look at MiCA, for example, and I'll come on to that, they're also looking for fungibility. So effectively, you can transfer it between a number of parties, and it's not just something which you can effectively get from an issuer only, and so on. Coins differ in nature. And so what you'll find is that, yes, everybody knows about Bitcoin, which doesn't actually refer to anything real, but it's possible to create tokens that do refer to real things, either on a one-to-one basis or on the basis of fractions of a real asset or on pools of real assets. So when you look at pools, for example, you might be talking about asset reference tokens. Those could be stable coins, which are pegged, for example, to a fiat currency, but it's also possible to create an asset reference token, for example, pegged to the price of gold, or and so on and so forth. So you can create all different types of token, and I can tell you, we have looked at hundreds of these. I'll come back to what we've done and how they should be classified from a regulatory perspective. But coming back to the legal characterization, this is quite a difficult thing, because are we talking about property or are we talking about contractual rights? Because what you're talking about is effectively digital records, and it's a record that's updated all the time. So it doesn't actually stay the same. So the record tells you who owned the thing at which particular point in time, and it keeps being updated. And you access it using different types of cryptography, either through public keys or private keys and so on. And so this is an issue that both legislators and courts have battled with over the last couple of years. So I'm going to start with what's happening here. So we're all very eagerly awaiting a report from the Law Commission here as to whether in the law of England and Wales, digital assets should be property. And the last thing, because I was involved in some of the correspondence on that, the last thing I heard is that they were minded to make it a third category, something between contractual rights and property rights, which is very interesting. It's going to be very interesting also to work out what that then means for things like taking security, trusts, lending, all of those sorts of things. Other countries have actually made legislation. So the US state of Wyoming is a front runner there, as is Liechtenstein, but these are small countries. What's now very important is the development in the United States, because they're looking to amend their Uniform Commercial Code, Article 12. And what that will do is effectively make it more possible, make it easier to take security interests in cryptocurrency and non-fungible tokens, Because at the moment, apparently, if you want to do that in the US, it's not good enough just to have control over a digital wallet. You also have to have a thing called a financing statement, which fully describes the coin or the token, and that's just made it very, very difficult. So if adopted, Article 12 would specify the rights that purchasers acquire in the digital assets to facilitate transactions. And it all hinges on this concept of control. The question is going to be, will the lender get control of the actual asset? But it will only go so far. So, for example, it's not going to deal with, for example, how to determine who's got title. It will effectively just hinge off this concept of control. Then in the UK, we've had a number of attempts by the FCA in particular to classify tokens, and I think you possibly are already familiar with that. So that there are certain tokens which are clearly outside of the scope of regulation at the moment. So exchange tokens, for example, are currently outside of the scope of regulation. Stable tokens are ones which the Treasury is consulted on in bringing into the scope of regulation, but are not necessarily, depending on their features, within the scope of regulation. So every time you get to look at a token, which we do a lot, so we act for some of the exchanges, and people want to list their token on the exchange. So we get to do a report, and we have to take the regulated activities order, go through every different types of financial instrument and go, no, not that, but that, but that, but that. And very often where these things have pitfalls is they are collective investment schemes. We often see ones that effectively have features which make us conclude that they are collectives. Enough on that. Let's look at the evolving case law, Davina.
Yeah. Well, as such a new and rapidly developing asset class, crypto assets do raise many new legal issues. And given there's little legal precedence in this area, the courts are first having to grapple with some of the key questions, like what, as Rosalie mentioned, legally a crypto asset is. And in dealing with these questions, the English courts have demonstrated their willingness to apply existing legal principles to the world of crypto. And the overall theme of the case law to date has been the application by the English courts of existing legal principles to crypto assets. And the Master of the Rolls, Sir Geoffrey Voss, actually gave a speech on seizing the opportunities of smarter contracts back in February this year. And just for future reference, you've got the link to the full speech on the slide there. And in it, he really emphasised the importance of the UK and its courts as being at the vanguard of blockchain and crypto technologies. And he commented that litigation involving crypto assets and smart contracts is rising, but he also noted that those cases are proving really complex because of the difficulty of applying historic analog rules to the digital environment. But importantly, he noted that crypto assets are to be regarded as property under English law. And this has been picked up by other commentators in the legal world. Back in November 2019, the UK Jurisdiction Task Force of the Law Tech Delivery Panel gave a legal statement on crypto assets and smart contracts. And they similarly concluded that crypto assets should, in principle, be capable of being treated as property under English law, and smart contracts are capable of satisfying the requirements of a contract under English law. And although that's not a legally binding statement, the courts have found it to be really persuasive in dealing with the questions. And I'll briefly run you through some of the key cases in this area. And again, for future reference, you've got the full links to the cases in the slides and the links. To begin with one of the most important cases in this area, that's the case of AA versus Persons Unknown. In the case, the High Court found the analysis of the UK Jurisdiction Task Force to be really compelling, and noting that it should be adopted by the court. In the case, an insurer was the victim of a malware ransom demand and sought a proprietary injunction to recover the Bitcoin. And the judge found that crypto assets such as Bitcoin do constitute property under English law, and so can be the subject of an injunction. The courts have also recognised that crypto assets are, in principle, capable of being held on trust. And that was really picked up in the case of Wang and Darby. which concerned the exchange by two parties of digital assets, Tezos and Bitcoin, on the understanding that there would be a transfer back at a later date. And a dispute arose when the assets weren't transferred back as agreed. Based on the facts of the case, the court held that the bilateral exchange and re-exchange on demand actually constituted a sale and buyback arrangement, so it couldn't be held on trust. But the court held that in principle, there was no reason why crypto assets could not be capable of being held on trust by a beneficial owner. Given that the courts do therefore appear to be recognising crypto assets as a form of property, traditional asset preservation remedies like freezing orders and third-party debt orders have also been granted to victims of crypto fraud. And that was noticeable in the case of Robertson and Persons Unknown, in which the claimant was victim to a spear phishing attack, in which he was fooled into sending 100 Bitcoin from his crypto wallet to a fraudster. And the court accepted that he had a proprietary claim and granted an asset preservation order over the stolen Bitcoin to prevent any future dealings with the asset. In another case, Iron Science Limited versus Persons Unknown, what is known as a banker's trust order was granted to allow the claimant to identify the company owning the wallet that was used to execute a fraud against them. And the court then made a third-party debt order in favour of the claimant, allowing it to recover losses from the account. And the English courts have also been willing to apply freezing orders and other injunctions in relation to crypto assets that have been fraudulently misappropriated. In a recent case, Danish Persons Unknown, the High Court granted the claimant an interim proprietary injunction and a worldwide freezing order against the Persons Unknown. And the court recognised that this was a case of exceptional urgency, given the risk of assets being dissipated at the click of a mouse. So continuing that theme of the application of existing legal principles to the world of crypto, the English courts have also indicated a willingness to apply concepts like fiduciary duties to crypto assets. And that was clear in a case known as Tulip Trading Limited versus Persons Unknown. In that case, the claimant was a victim of fraud. And to obtain a remedy, the claimant argued that the developers of the software, who had control over the blockchain protocol, should be ordered to write code to grant the claimant control over the Bitcoin. And the claimant argued this on the basis that the defendants owed tortious and fiduciary duties to the claimant. On the facts, the court found that no tortious or fiduciary duties were owed to Tulip because of the particular relationship between a blockchain user and the developers. But there was no reason in principle why such kinds of duties couldn't be owed to crypto market participants. And in a much anticipated recent judgment, which actually a member of the audience mentioned this morning, the courts have also confirmed that there's no reason and no realistic arguable case why non-fungible tokens could be treated as property under English law. And that really brings NFTs in line with some of the existing authorities in relation to crypto assets. And that was the case of Lavinia Deborah Osborne versus Persons Unknown. And in the claim, the claimant, Lavinia, who's also the founder of the Women in Blockchain Talks, brought proceedings against Persons Unknown who had allegedly transferred without her consent 2 NFTs from her digital wallet. She was able to trace the NFTs to 2 other wallets, but was not able to identify the owners of the wallet in question. And so as a preliminary matter, the judge considered that there was an arguable case that NFTs were property under English law, and the court went on to grant an interim proprietary injunction to freeze the NFTs until the end of the proceedings, so that they couldn't be dissipated, and also a banker's trust order, which compelled the wallet operator to provide the contact information for the individuals in control of the wallets, so those could be traced. And so to give you a couple of takeaway points from the English case law, it's a really rapidly developing space. And the English courts have confirmed their willingness to grapple with the novel issues raised by crypto assets. Judgments to date suggest that crypto assets are property in the legal sense, and the courts can deal with ownership disputes and protect victims of fraud through, for example, worldwide freezing orders, bankers' trust orders, and third-party debt orders. we're likely to see further developments in the case law which extend the legal mechanisms available to victims of fraud. And as Doug has picked up and will touch on, the recent turbulence in the crypto market is likely to result in a greater number of claims being brought and more helpful precedent being established.
So now let's move on to looking at regulators' concerns and then at regulatory developments, first worldwide and then in the UK and in Europe. So in terms of regulatory concerns, there are a number, but I think they sort of cluster around certain key themes. So one key concern is consumer harm. The FCA in particular has picked up that this is a key problem with crypto, and they feel that there's a mismatch between the risk tolerance of the actual purchasers or users of crypto and the volatility of the asset. Also, there's concern that the market is relying on a very few and actually a decreasing number of largely unregulated crypto exchanges, and those crypto exchanges have poor risk management. So what you'll find is that it's a single institution doing a lot of things that in the traditional world you would actually want to segregate. So for example, the crypto exchanges often offer custody services as well, but in traditional finance you would typically have custody separate from broking, for example. On financial stability, a number of issues have been raised by a number of regulators, but most recently, and I think very presciently, by the Financial Stability Board. So the Financial Stability Board is concerned about the increasing interconnectedness between the crypto universe and traditional finance. And in particular, as I mentioned before, the way in which certain stablecoin issuers actually rely on reserves, which are then actually instruments issued by traditional banks. So, for example, commercial paper. And in particular, they said, and this was in May, so before the current events, that stablecoins in particular are susceptible to sudden and disruptive runs on their reserve with the potential to spill over to short-term funding markets. So that's their concern. And they're suggesting that actually these issuers should be subject to similar prudential regimes as traditional banks, and we'll come on to what that might look like. Then other concerns have to do with market integrity. So the whole reason why we have such large market capitalization in relation to stablecoins is because it's quite difficult to exchange fiat currency for cryptocurrencies. And so typically what people do is they use what's called in the lingo on-ramp into the crypto world is using stablecoins. And that is why there are so many, why the stablecoin issuance is so large. But that also means that there's a key area of weakness, because if those stablecoins fail, as is currently happening, then actually accessing the other crypto assets become difficult. They also regulators see the fragmentation, which Lizzie spoke about right in the beginning, with all the different coins as a source of weakness, effectively. And it rather suggests that crypto cannot really be money, because the whole point of money is that it's something which you can use to pay for lots of things and lots of people have access to it. Whereas if you've got a proliferation of coins, that can't possibly fulfill that particular function. The other issue which they raise is the point that I was making earlier around effectively what we call gas fees for validators, that because the system effectively has certain features, so Bitcoin, for example, is limited to a certain number. So as you get closer and closer to the total number, the price of effectively and the cost, not just in monetary terms, but also in power, energy, which is another issue, becomes higher and higher. So that also won't work for money. The other issue, which I mean, Davina has touched on, because we've made all these wonderful freezing orders and all of that, but they need to be enforced, right? And that makes it quite difficult, because we're talking about a market which is 24/7 and it's completely global. Now, the truth, though, is that the regulators, in particular the US regulators, have had some success in enforcement, because the wonderful thing about digital is that it leaves a footprint. So you can find things out. But it's still quite challenging given how large the market is. Then financial crime obviously is a major source of concern, and I'll come on to what the FATF or FATF is saying around that. But all of this said, people still think that this technology potentially could upend and change all of our financial systems. And in fact, that is the way in which Sam Bankman-Fried, who is the owner of FTX and is considered by the economists possibly the JP Morgan of the crypto world, he's seeing the real value in this as this potential, this future, that all of this technology might be able to upend and modernize traditional finance. The question is just, how do we get there? A very quick graph there, which I found was an interesting one, which is just crypto theft. I mean, just as well it's property, because if it wasn't, then it's not theft, right? So it's going up. Regulatory developments. So here, I mean, we were specifically asked to talk about the future of crypto regulation. Now, I think always when you look at future developments, key thing is to look at what is happening on the international arena, because there's recognition that this is an international market. So a number of the international standard setters have come out with papers very recently, over the last couple of years, but also in June, a number of very important papers, which I thought I'd touch on for the benefit of the audience. So starting first with the Financial Stability Board, which I've already mentioned. Now, I think this particular paper from the Financial Stability Board, which is the Regulation, Supervision, Oversight for Global Stablecoins, that was really a response to Facebook's project, the Libra, and then later renamed Diem project. You may remember that this was going to be a multi-currency coin, which would have, the vision was really that it would actually simplify payments across borders and actually provide financial inclusion for lots of people in countries who can't normally transfer money easily or cheaply. So it actually had great promise, but there are a number of problems because there was no sovereign behind it, especially when you have a number. And so it wasn't fiat, it was something else, right? And then the other issue with it was that there were concerns around the reserve and how that would work. And in the end, what happened, as was widely reported in a really good article that was published in the Financial Times, is that the Federal Reserve in the United States killed it. Janet Yellen said no, and that was it. So what FSB then did is said, well, if there's ever going to be one of these again, then there are a number of principles that have to be followed. They published 10 principles, and I've set out some of those. One is that it needs to be regulated. There needs to be cooperation internationally to regulate such a thing. Anybody who wants to issue such a global stable coin would need to be subject to recovery and resolution type rules that the GSIBs are subject to. And we need transparency in data. And the slides, when you get the slides, you can click on the link there and you can listen to the talk on that. So that's interesting because it's actually galvanized some of the thinking, some of the international thinking around crypto. Next, and very important, is the Bank of International Settlements and the Basel Committee. So in their June 2022 annual report, they make a number of points, which I think is really good. So first of all, crypto fears, the fears that they've actually mentioned, which I talked about before, are all materializing. And they have a number of recommendations. So they do think that crypto activities need to be regulated. They need to be regulated quickly, and they need to be regulated in such a way as to minimize arbitrage between crypto companies and traditional finance. Breaches of anti-money laundering should not be tolerated, and crypto exchanges that breach those laws should be shut down. Disclosure should be improved, so disclosure to regulators so that regulators can actually protect consumers. There should be prudential rules for crypto firms, but again, and this is a very interesting, so the second part of the first part of the paper is kind of dark, doom and gloom. Second part is, well, but actually, we can use this technology. And what they do is they compare crypto world, fiat currency world, and potential central bank digital currencies. And they look at a number of features of those to see whether the technology could actually be used for that. So they look at things like, is it safe and stable? Is it accountable, or is the whole structure accountable to the public? Is it efficient? And do you have issues with fraud and theft? So the DeFi sector, for example, is adaptable and open, but it's not safe and stable, and it's rife with fraud and theft. But similar technology might be able to might be used for CBDCs. And what's very interesting with CBDCs is that people are starting to develop technology to address the very real privacy issues because of course with the technology you could trace whose expenditure it is. So apparently there's now technology which will actually address that, but I'll leave that point there. Even more important for you as right now, given that you've said you don't have crypto assets on your balance sheet, is the Basel paper that was published on the 30th of June, which has to do with the treatment of crypto assets on your balance sheet. And how do you deal with that within the Basel framework? So no matter where your prudential regulation is, if it's in a country that's a member of the Basel Committee, their decisions, their local regulators' decisions will be informed by what the Basel Committee is saying. It all depends on what kind of crypto asset you're talking about. So what the Basel Committee initially did last year was to divide the universe between traditional financial instruments, which are tokenized. Those are to be treated in exactly the same way as the underlying. So a share that's tokenized, it's a share, you treat in the same way. Then you have a thing called Group 1B assets, which they've kept the concept of, which is where a crypto asset where you have effective stabilization. And they've now expanded on that in the June 2022 report. And then Group 2, which is other crypto assets. With Group 2 in particular, they are treated as intangibles from an accounting perspective. And initially, that was the reason for the Basel Committee applying 1,250% risk weighting, which basically means it's 1 for 1. You have to have the same amount of capital as the exposure to crypto, which is massive, right? And that, I think, explains why you all said, no, you don't have an exposure to crypto asset, because you can invest in other things, which effectively, or you can have exposures in other things, which give you some exposure to the crypto market, for example, a share in a crypto company, which will not have this very punitive treatment. They're not really stepping back from this punitive treatment, unfortunately, it seems to me. So very briefly, because I think it's important, because if you can actually get the stable coin into that category 1B, then it won't be as punitive. So how might you do that? They have two tests. They have a thing called the redemption risk test and the basis risk test. So with the redemption risk test, the objective of the test is to ensure that the reserve for the stablecoin are sufficient to enable the crypto assets to be redeemable at all times, including during periods of extreme stress. And the PEG value, which is the value of the reference asset, to which the unit of the crypto asset must be designed to be redeemable effectively. It must be redeemable for that PEG value. The basis risk test is that you should be able to sell that crypto asset at an amount which closely tracks the PEG value. And there is a little bit of flex in there. Initially, they suggested a 10 basis points threshold. So if you can sell it within that band, then tick, it's fine. But people then said, well, you're introducing a cliff effect by saying that. So they've now added a number of tests in terms of how many times during a period in the immediate past has the crypto asset effectively passed that basis risk test. So if it frequently becomes depegged, then you won't pass the test, for example. So that's very interesting in the current market environment. So let's say you have a stable coin that actually passes the test, then the credit risk treatment will be the same as for funds. You're going to look at the underlying and you're going to apply the same stuff as currently are set out in the Basel papers. And then you, on top of the credit risk embedded in the underlying assets, i.e. in the reserve, you will have to add the credit risk of the issuer, unless you've got a legal opinion, us, which effectively says that you can access the reserve assets without taking the credit risk of the issuer, so that they are ring-fenced for you. So that's what we're talking about with that. In addition, they're not making it easier. The conservative treatment is continuing. So you'll have to have an add-on for a stablecoin that just passes the test, right? And further, you have to have an infrastructure risk add-on of 2.5% of the exposure. Group 2 crypto assets, that has to be capped at 1% of your tier 1 capital. And they've introduced a new Group 2A. So Group 2A has a slightly better treatment than Group 2B in that you can take that you can take advantage of hedging effects. You still have to have capital also for the operational risk embedded in all this, and you have to consider it for both your liquidity coverage ratio and your net stable funding ratio. So this is why, and you'll see when I come on to what the PRA has done, this is why you don't have crypto on your balance sheet. Anyway, that could change, we shall see. Some of the other international regulators, very briefly, IOSCO and OECD, worth mentioning. IOSCO, they're very much focused on retail investor protection, and there's a consultation paper out. No conclusions in it yet, but it's worth picking that up and having a look at that. In particular, the IOSCO is concerned that a lot of the selling of crypto assets happen via social media. So they're asking, and I thought this is an interesting point, whether regulators should actually look at and actively monitor using digital means what's happening in the crypto world on social media. OECD is important, and I'm just going to mention this. Our tax partners are doing quite a lot of tax work in relation to crypto. They're looking at a new global tax transparency framework for tax information in relation to crypto transactions. I think the addition of the regulatory developments plus the tax developments will change the universe quite a bit as well. Finally, very important, they have expanded their recommendation 15 and 16, and they are looking at the implementation of the travel rule, which basically is a rule which says that institutions must identify both the sender of the crypto as well as the receiver of the crypto. And there are different rules for how much detail you need, depending on whether you are talking about a transfer inside a country or cross borders, and whether the threshold is passed or not. There's a threshold of €1,000 or dollars. FATF did say that a lot of countries are still not actually implementing this, and we come on to the UK in a second on that. So moving on to the UK very quickly. Now, this may all change given what's happened last night, but when I wrote this, Matt Hancock, who, as you know, is a previously disgraced politician, has taken on the promotion of crypto. And in June, he did another talk about crypto, and he said, my mission is to make Britain the home of crypto. And I couldn't resist putting a Victorian terrace there. But anyway, he wants the UK regulators to be more crypto friendly than they are, so that the FCA should not be as conservative as they are. And the PRA, again, should just ensure that not more than one entity is systemic. Query whether his ideas will be followed, but there does seem to be, or it did seem to be the case, that there was some disjunct between the Treasury and the regulators. And this is on a number of issues, not just crypto, but you would have seen Solvency II issues as well, that there's a sort of promise of making Britain more friendly for financial services. And then the regulators are saying, yeah, but hang on, what about all these issues? And that's also the case in crypto. So Hancock, for example, cited the fact that since 2020, the UK banned listed products referencing crypto, but 117 of those products are available in Europe. So saying that that is a bad thing. So let's have a quick look at some of the UK developments in relation to crypto. I just want to focus on two aspects, and that is firstly the FCA ban on crypto, and what that means and whether that's really a ban on crypto itself. And then secondly, the financial promotion proposals. So first of all, the ban is not actually a ban on crypto itself, because crypto is unregulated, so it's not within the FCA's remit. But derivatives on crypto and structured products referencing crypto are within the regulatory perimeter. So what the FCA did is they used the MiFID product ban powers to ban the sale of crypto derivatives and structured products to retail customers. So that ban effectively is aimed at existing MiFID firms, because they can only exercise that power in relation to MiFID firms. It was widely misreported, and I think the FCA wanted it to be widely misreported. The headline was FCA bans crypto. No, not quite, but they did ban something for some people, and they had a power to do so. That is still in place. So if you need to look at that stuff, it's in COBS 22. Then the financial promotion regime. Now, as somebody who's been doing financial regulation for over 20 years, I just could not understand this proposal. I'll tell you why in a minute. it's not that controversial that they want to extend the financial promotion restriction to qualifying crypto assets as they're defined with all of those features. But what's really weird is that they wanted to ban promotion or make promotion more difficult, yet not also have a licensing regime. Because if you look at the way financial regulation works at the moment is that you can't make a financial promotion unless you're authorized. But there is no authorization being proposed for the same crypto assets, which therefore means that firms that actually promote crypto assets need to get somebody to approve their financial promotions. But you can only approve a financial promotion if you're authorized. So you're in a circle where it just doesn't quite work. And discussions, I mean, these points were all made by people who responded to the papers on financial promotion. It's going to be very interesting to see where they come out. I mean, so much so that I have it on some authority that the FCA has actually asked some of the existing regulated firms whether they'd be available to approve other people's advertisements. And they said, we don't really want to undertake that risk, which is kind of a really, it's not an unexpected response. It all matters greatly because financial promotion is linked with a criminal sanction. If you make a financial promotion and it's not made by an it's not either made by an authorized person where that's possible or approved, then you get not just criminal sanctions, but potential unenforceability. So they need to get this right. Let's move on because I'm conscious I've been talking for a long time and there's still a few more things to mention. PRA. It will not surprise you that the PRA has decided to follow the Basel Committee's recommendations on the prudential treatment of crypto. And they wrote in a Dear CEO letter in March to banks saying, you know what, you need to do what the Basel Committee is talking about. So it's the 1-for-1 on the capital. And by the way, we're going to really look at your operational issues. You need to have strong risk controls. And by the way, you're going to have to be in a discussion around your Pillar 2 as well. So not only are you going to have that very severe treatment under Pillar 1 for capital, but Pillar 2 as well, we might just add some too. So I'll leave that there, but I think that the regulator's view is very much we want to be in line with international standards. Registration of crypto firms. This has been a hugely controversial area because the way in which the UK decided to implement the 5th money laundering directive was to require certain crypto firms, basically crypto exchanges and crypto wallet providers, to register with the FCA. They really took so long to do it. It was extremely difficult, and they used that process to effectively almost as like a witch hunt on in relation to certain firms. So there are a very limited number of firms with that registration. The other thing that they did is they said, if you're already an authorized financial institution and you're doing all the anti-money laundering stuff, right, you still have to have a crypto registration in addition, is what their guidance is, which is strange and seems like overkill, but that is the position. This has been amended again, or is being amended. Very briefly, we are implementing the travel rule stuff that I showed you from FATF, as well as the provision on unhosted wallets. And in addition, a change in control regime, similar to the one that we've already got for authorized firms, will apply to registered crypto firms from next year under that amendment. I'm not going to go onto this cross-border marketing. I think that's obvious. Well, not obvious, but I think we've running out of time. Very briefly, MiCA. MiCA is the new European regulation for crypto assets. And trilogue agreement was apparently reached as of the 30th of June, so just a few days ago, but we don't have a final text yet. The easiest way in which to understand MiCA is that it has a prospectus directive type regime for certain crypto assets, right? That's the first part, with issuers having to publish white papers and so on and so forth. And then it has a second part, which is like a mini MiFID for crypto firms. And that's not just for the same crypto that can be issued, but for all crypto effectively. So that's what I'm going to mention. We are doing a separate talk about MiCA next week, a webinar. So if anybody's interested, let me know. It's being done by my colleagues across the continent on that. So much more detail on that.
Yes. Why might banks be worried about crypto? What we thought we'd, yeah, absolutely. What we thought we'd do is look first at the position where a bank has no direct exposure to the crypto markets because it's not doing crypto business. Might it nevertheless still need to be concerned about the risks arising from crypto? And our practical experience is that, yes, there may be instances where you do need to be concerned. And the reason for that is that although the crypto ecosystem has evolved greatly in recent years, it will still at times need to interact with the traditional financial system. And when it does so, banks are often the gatekeepers or the intermediaries, and so they're involved somewhere. And when things go wrong, someone suffers a loss or there's an issue that regulators are interested in, it's often going to be the case that the counterparty to the crypto trade, the crypto business, isn't very attractive as a target or a defendant because they're offshore, they're not regulated, they're hard to get to. But if there's a bank involved somewhere in the chain, they're much more attractive. They've got deep pockets, they're regulated, they're onshore. So people do look at banks as targets in this way. And there are two examples of this happening on the slide. On the left-hand side, there's a scenario that we've encountered where a bank will have a customer, it could be a corporate or an individual. The customer wishes to get involved in crypto. So they instruct their bank to make a payment to a crypto business, be it an exchange or whatever it may be. And the payment could be high risk for several reasons. There are many scams and frauds in crypto. So the customer could be an unwitting victim of fraud. There's also high volatility. So it could be a legitimate investment, but which nevertheless causes significant losses. And so when a loss arises, the customer may look to the bank for compensation. And so the kinds of arguments you see being run are, well, the bank should have advised me against the risk of this transaction, protecting me from myself, or perhaps something that's got slightly more merit is a claim based on the quince-care duty, which, for those of you not familiar, is a duty on banks to decline to execute a transaction in circumstances where the bank is on notice that it may be an attempt to misappropriate the customer's funds. And so it's often said by people in this scenario, well, there are red flags that the bank should have spotted. You should have questioned why I wanted to send my life savings to a crypto firm, blocked this transfer, but you failed to do so, so you're in breach. Just pausing briefly on quince-care, some of you may be familiar, there's been a Court of Appeal decision recently which has opened the door to much wider use of that duty by individuals as well as corporates. But I think for banks, it's probably corporates where there's a greater risk in this context because the bank will be familiar with the corporate's history and its business. And so there's more scope really for the corporate to say, well, you should have identified something about this transaction that was unusual because you know what our business is. You should have questioned why we sent money to a crypto firm. So that's the first example. The second example is where the bank's customer is itself a crypto business of some kind, and it may be that they're just a banking customer, or they may be using some other service the bank offers. And we've seen scenarios where regulators will be concerned about what crypto business is doing, but if they don't have jurisdiction over the crypto business, they may contact the regulated bank and strongly suggest that it might cease doing business with the crypto firm and encourage it to end the relationship. And if there isn't a very clear-cut right to terminate the contract in that scenario, the bank could be the subject of a breach of contract claim, depending upon how the regulator puts its suggestion. It may not be as clear as a regulatory obligation that would come within a right to terminate. So there's the potential for civil litigation. There's also the potential for the regulator to want to understand more closely how the bank came to onboard the crypto business in the first place, and may want to look at its onboarding processes in a way that could itself give rise to a risk for the bank. So those are some examples of indirect exposure. If we move on to the next slide, then I suppose Crystal will gaze a bit in terms of what may be the risks if a bank were to be directly involved in crypto business in some way. And the thing I wanted to talk about the most really is legal uncertainty as a risk. And Davina has already talked about the very helpful English law judgments we've had, where the courts have extended concepts like property law, trusts, and so forth to crypto. But there is still, I think, quite material uncertainty and scope for things to change because Many of the decisions you've had to date have been first instance ex parte without notice applications where a victim of a fraud seeks a remedy. So you don't have the other party in court present to make the counter arguments about, for example, whether crypto is property or not. And so the courts haven't really heard all of the arguments. And there are counter arguments. So academic lawyers, for example, have put forward arguments as to why crypto should not be treated as property. And Rosalie's already mentioned the Law Commission and its work around the categorization of crypto as personal property and whether we need to have a third category. So there's uncertainty there. And I suppose it's possible that in future you could have a scenario where two commercial counterparties who have diverging interests have a dispute concerning these issues. It could go on appeal to the Court of Appeal or the Supreme Court, and there could be a surprise decision which reverses perhaps the understanding we have presently about the legal treatment of crypto assets. And even if it's not quite that dramatic, there's still a great deal of, I think, detail and things to be worked out. So, for example, the application of insolvency law to digital assets, I think we'll see a great deal of development in that area, but at the moment, it's still quite uncertain. There have been some decisions in this area in other jurisdictions, so in New Zealand and Singapore, there have been cases of this nature, but so far, not really in England, although I'm sure that what's going on at the moment in the markets will generate litigation, and probably several years from now, there'll be much greater clarity and certainty. The next risk on the slide is the lack of standardization and the complexity of digital assets. And the point here really is a simple one, which is that anyone can create a blockchain with its own native currency. Many people have. So there are a huge number. Each is unique in terms of its legal and economic features, and therefore has its own potential for flaws, misunderstandings, misdescriptions, those kinds of things, which when there are losses can give rise to claims. And it links very closely to the third point on the slide, which is who bears responsibility when that happens. I've already mentioned that people who suffer losses may not view crypto firms as attractive defendants because of where they are or who they are. And they may instead look to fix responsibility on the bigger players in the market who will be able to satisfy judgment debts and who are regulated. And so you can see how arguments may be made that if a bank is involved somewhere in the distribution or in making available crypto to investors, that it's assumed some kind of responsibility, whether that's how it's described, the product, or in terms of the diligence it has done before offering it via its platform. So there's scope there, I think, as well for risk. And finally, just touching on regulatory scrutiny, there's obviously a risk around distributing digital assets, but I think there's also some risk around the use of the technology, even things like DLT and blockchain, because there's a divergence we've noticed between pronouncements by governments and regulators, which are broadly, in some cases, pro-crypto, pro-DLT, and then the experience on the ground of working with the regulators, many of whom are clearly very uncomfortable with how these things work, probably because they're not familiar with them, aren't sure about how they operate in practice. And so banks that do use those technologies will need to have very robust controls in place in terms of governance, diligence, operational resilience, all of those things, because one can see how if a bank were to be involved in a market event where there's material losses and they have exposure, regulators may want to understand, well, what were your controls? How did you come to be involved in this? How did you ensure you were mitigating the risks you face? So that's all to quite a high level, but that's because I think there's still quite a lot of risk out there, and I'm sure will develop in the coming years.
So taking that further forward, what about the future? Well, I think that we'll see more regulation of crypto in the next 12 to 24 months. Obviously, MiCA is going to be in, and we'll have some form of UK regulation. So that's definitely on the cards. We might have further clarification on what crypto actually is, not just in the courts, but actually in further legislation along the lines of what I discussed. CBDCs, I put there medium term because they've been working on it for a long time. But what's very interesting is that 90% of central banks worldwide are working on a CBDC project. So that is certainly something which is about to come, and quite a number of the projects are actually quite far underway. So there are 3 live retail CBDC projects, including the one, the pilot by the People's Bank of China, which already has 261 million users. So what happens there will become very, very interesting for the global financial system on that. I think in terms of traditional finance, while we keep the accounting treatment and the prudential rules that I've told you about, I think that it's unlikely that you're going to take actual crypto onto your books. But I think that clients will continue to ask for this, and there will be even more interest from banks in either investing in crypto firms or in offering crypto access products, derivatives, structured products, and so on to their clients. And with that, I think we've finished for the sort of formal part. There are 1 or 2 more things to mention before questions, right?
Yes, indeed. So thank you very much to the panel for what I hope was a very helpful run through of the current state of play, of regulatory focus, and also future, together with obviously the litigation side of things that runs along in tandem with all of this. And I think it's safe to say that there has been a shift from the institutional reaction, if you will, on the traditional banking side to crypto a couple of years ago, which was we don't want anything to do with it, to now thinking, well, what if and what would this look like? And assuming that all of you are in a position where you have to advise your business on risk in some form or other, then the questions that will be coming to you are very much in the realm of crystal ball gazing in some ways. What might those risks look like and how can you mitigate them? So with that, we'll move on to our Q&A to the extent that anybody does have any questions they would like to flag now, or indeed if you'd feel more comfortable doing it. Oh, yes, we are going to stop the recording. If you'd feel more comfortable doing it separately or following up with us afterwards, we're also very happy to. But what we're very keen to do is to try and track, if you will, the types of questions that you are seeing live, because again, given that this is such a fast moving area and such a fast paced area, the questions